Hello, and welcome to University Credit Union's virtual workshop on becoming a homeowner. The goal of this workshop is to give first-time homebuyers the knowledge of the home buying process, including savings, getting a mortgage, searching for a home, making an offer, and preparing for closing. Some home values given in examples may be above or below the average of what first-time homebuyers in your area typically spend, and other things, such as the amount paid for closing costs, real estate practices, and first-time homebuyer programs can vary as well. Now let's get to the reason you're here. Buying a home for the first time is exciting, but also a little scary. However, as you can see from the slide, buying a home is really just a series of defined steps. Learning about the process and how to best prepare can make buying a home much easier. Savings is an essential part of preparing for home ownership. There are several things you will need to save for, including your down payment, which can be between 3 and 20% of your purchase price. The more, the better. Closing costs, which average between 3 to 5%. And your lender will also require post-purchase reserve funds, which allow you to pay your mortgage in the event you experience cash flow problems. And such things as repairs, renovations, and furniture are all additional costs. Currently, University Credit Union has a closing cost promotion where we will pay up to 2% of the loan amount, up to $5,000 for certain third-party fees like your appraisal, credit report, tax service fee, processing fee, flood certification, and title charges, just to name a few. Making regular deposits to your savings is one way to get the cash you need, but it isn't the only one. Some first-time home buyers receive assistance from their parents or family members. Usually, this type of assistance must be a gift and not a loan. It is important to check with your lender if this is how you plan to pay your down payment. Another way of generating is through selling assets. In order to get a mortgage, especially one with a good interest rate, you usually need to have a favorable credit score. The FICO score is the most common scoring model. Scores range from 300 to 850. The higher, the better. A lender may check your scores from all 3 credit bureaus or only one. The 2 most heavily weighted factors in the FICO score are your payment history and level of debt, also known as your use of credit. If you make a late payment, your score will take a hit. The more recent, frequent, or severe the late payments are, the lower your score. Even if you make your payments on time, your score may be low if you carry large balances on revolving debt like credit cards. Other factors that have an effect on your score are the length of your credit history, the variety of your accounts, and your creditor inquiries. If you do not know what your scores are, it is a good idea to check them well before you plan to purchase a home. Improving low scores can take time, but don't become discouraged if your scores are not as high as you would like them to be. There are several things you can do, such as making payments on time going forward. If your balances are high, focus on paying them down and not incurring any future debt. And time is also your friend when it comes to your credit. What has happened in the past 2 years has more impact than what has happened before. And typically after 7 years has passed, most negative information is removed from your credit report. Even if you don't have great credit, you should still check your credit report at least 60 days before applying for a mortgage because it may have errors. Don't just depend on third-party reporting sites like Credit Check Total and Credit Karma when looking at your scores, since they may not have the most accurate information. You can get a copy of each credit report for free once a year at Annual Credit Report Request Services. If you see any errors, call the credit bureaus or submit a dispute form online. You can also visit ucu.org and click on the Learn tab to get more information about credit scores and reporting. Before making an offer on a home, you would either be pre-approved or pre-qualified by a lender. With a pre-qualification, you are given an estimate of what you can afford. When you're pre-approved, you get a commitment from the lender to provide a mortgage up to a certain amount as long as you don't have any major financial changes. Many sellers will not consider an offer without a pre-approval, and going through the process will better assist you and your real estate agent in identifying properties. You don't want to put in an offer on a $500,000 home if you can only afford $300,000 mortgage and don't have the difference in cash. Lenders also may include many factors when deciding whether or not to approve a loan and how much to approve you for. They typically include things such as your credit score, assets, employment history, income, and existing debt. After gathering all of the necessary information, the lender will approve your loan or deny it. If your loan is approved, the lender will tell you the amount you can borrow and the interest rate. Because lenders adjust their interest rates frequently, the rate you are given at approval is not necessarily going to be the actual interest rate. It is determined at closing. Some lenders offer the option of locking in the interest rate you are given at approval, but may charge a fee for this service. Within 3 business days of receiving your loan application, your lender will give you the loan estimate, which shows the amount financed, total amount that will be paid back over the life of the loan, annual percentage rate, finance charges, total number of payments, amount of payments, late payment policy, as well as prepayment penalty if there is any. The loan estimate may also include an estimate of your closing costs. Be sure to read this carefully and ask for clarification from the lender if you have any questions. There are several types of mortgages available. Fixed rate mortgages come with an interest rate that remains constant over the life of the loan. The interest rate is usually initially higher than other types of mortgages. However, because the interest rate and payments are fixed, they provide a stability that is appealing to many buyers. The adjustable rate mortgage, or ARM, have a period of fixed interest, but once that ends, the interest rate and payment adjust at specific intervals. In general, the interest rate and monthly payment for an ARM start off lower than a fixed rate mortgage for the same amount. However, they often become higher once a few adjustments occur. An ARM may be a good option for people who plan to sell in a few years or expect their income to increase significantly. If you are on a fixed income, your lender may not recommend this type of loan. There are other types of mortgages such as FHA and VA loans, which can have a low or no down payment. Getting a mortgage is not free. Besides the interest you pay each month, you will usually have to pay to close the loan and transfer the home from the seller to you. The lender is required to give you an estimate of these closing costs called the good faith estimate within 3 business days of receiving your loan application. Closing costs can include a loan origination fee, which is what the lender charges for processing and providing your loan. A title search and title insurance ensures that the seller is the actual owner of the house and that there are no liens against the property. The lender may require an appraisal of the home to ensure that they are not lending you more than its market value. A survey will confirm the legal recorded boundaries of the property. A recording fee is charged to record the transfer of ownership in the county or town records. And a prepaid mortgage interest is the amount of interest you will accrue on the mortgage between closing and your first payment date. Once you buy a home, you will have to start making mortgage payments. But what exactly is the money you send to the lender every month used for? Most of it goes to repaying the mortgage loan. Loan payments can be divided into principal and interest. With most mortgages, early payments consist of primarily interest. As you continue to make payments, a higher percentage goes towards the principal, and this is called amortization. Part of your mortgage payment may consist of money the lender collects on your behalf for property taxes, homeowners insurance, and in some cases, private mortgage insurance. Private mortgage insurance, or PMI, protects the lender against loss if you default on the loan and may be required for people with less than 20% down payment. Every month, the lender puts aside the money for these expenses in an escrow account and pays them when they are due. Together, the principal, interest, tax, and insurance payment are often referred to as PITI. Once you are pre-qualified or pre-approved for a mortgage, you are ready to start your home search. There are several steps you can take to find a real estate agent you will be happy with. Ask for referrals. Many of your friends and relatives have probably bought or sold their home through a real estate agent. You can also find out which real estate agents specialize in the kind of home or area you want. You can start by looking online, driving by your desired neighborhoods, and note the names on the for sale signs. It's always best to talk to several prospective real estate agents and ask questions about the areas and types of homes you are interested in. You want to ensure your agent is knowledgeable and their personal style is a good fit with your own. You may want to avoid the seller's real estate agent because the real estate agent is working for you and the seller. He or she may not be able to advocate for you. Also note that your real estate agent's commissions are typically paid by the seller of the home. UCU is a part of a benefits program that you can receive a 25% rebate on your real estate agent's commissions. Although the seller will pay your real estate agent's commissions, you can still benefit from this rebate through the Home Benefits Plus program. By taking time to examine your finances and to see what you can afford, you can enjoy your home and not have to worry about where the money will come from to pay the mortgage. What you are pre-approved or pre-qualified for is not necessarily the same as what you will be able to pay for your mortgage. Creating a budget can give you a better idea of what you can afford. Keep your housing allowance in mind when searching for a home. When you see a house you like, calculate what it will cost you per month. To calculate the loan payment, you can use a mortgage payment table or calculator. Remember to consider non-loan housing costs too, such as property taxes, homeowners insurance, maintenance, and in some instances, homeowners association dues. For example, if your gross total income is $10,000 a month, you will want your mortgage to be no more than 33%, which in this case is $3,300. You will also need to take into consideration other expenses such as food, utilities, transportation, movies, vacations, and so much more. While price is not the most important feature of a home, it is certainly not the only one. Your housing search will be more efficient and focused if you think beforehand about what you want. Most first-time home buyers' budgets are limited, so you may not be able to get everything you want. Think about what is important. If you have children, will they share a room? How many bathrooms do you need? And coming from someone who lived in a home with one bathroom, this is a big deal. Do you want a home that's move-in ready, or would you like to do renovations to fit your own style? It is important that you live near a freeway. How far is the local grocery store? Are there registered sex predators in the surrounding area? These are all things to consider when you begin your home search. When buying a home, there are several types to choose from. No one type is right for everyone. Look at your lifestyle and preference when deciding what to choose. The most common types are listed on the slide. With a single-family residence, you own the house and the land around it. You are not restricted by any rules and are solely responsible for maintaining the home and property. A duplex or multi-unit building is similar to a single-family home, only you own more than one legally divided unit. With a planned unit development, you own the house and the land directly around it, but the development as a whole is owned by the residents. Generally, there are restrictions as to what you can do outside of your house. Condominiums, also known as condos, consist of multiple units in one building. You own the interior of your condo and the building as a whole is owned by the Homeowners Association or HOA, which consists of all the units owners. The HOA is responsible for maintaining the physical structure of the building. You must pay HOA dues and follow the community rules. Condos are usually cheaper than single-family residences. Townhouses are similar to condos in that there is an HOA and the units are attached, but with the townhouse, you own the complete unit, including the roof, exterior walls, and the land it sits on. Manufactured homes are built in a factory and shipped to the location where it will be placed. Depending on the community, you may own the land underneath the unit or pay rent for a lot. Generally, manufactured homes are less expensive than other options. Now, how can you find a home? If you use a real estate agent, he or she will see what is listed on the multiple listing service or the MLS. You can also drive around the neighborhoods you are interested in and look for sale signs, or look at external websites that show homes for sale. Due to COVID, there are restrictions on viewing homes, but your real estate agent can let you know what the preference of the seller is for showing a home that you're interested in. If you look at a lot of homes, it can be easy for them all to blend together. Be sure to take notes on the home so that you can effectively evaluate the homes you like and make an offer. When searching for a home, try to avoid being distracted by things that are easily changeable, like the color of the paint or carpet. For any home you are considering making an offer on, try to drive by and visit it more than once during different times of the day. This will let you know if your neighbors are a little rowdy in the evening or if there's heavy traffic during the day. If you are interested in a condo or other types of developments with the Homeowners Association, it is beneficial to research that as well. The home's MLS should show the HOA dues, and you should be able to get the community's bylaws and financial statement from the seller. Once you find a house you want to purchase, your real estate agent will prepare an offer. Offers typically have at least 3 components: the purchase price, the closing date, and how long the offer is good for. Many offers have additional components such as seller concessions, inclusions, and contingencies. Seller concessions are costs the seller pays for the buyer, which reduce the amount of money the seller receives. Inclusions refers to things that stay in the home. If you want the appliances, blinds, chandeliers, or anything else to stay, put it in the offer. Contingencies refer to the conditions that must be met for the sale of the house to go through. They can include a home inspection contingency. Having the inspection allows you to renegotiate with the seller if there are problems. There's a financing contingency, and this makes your offer conditional on finding financing for a mortgage. You can even add this if you're pre-approved, because pre-approvals sometimes are revoked. There's an appraisal contingency, which your lender will likely require you to include to ensure that the sale price is not overinflated. They may send an appraiser to the home or use a computerized process. Your real estate agent will then present the offer to the seller and his or her agent. Along with the offer, it is customary to give the seller earnest money. Usually this amount is between 1 to 3% of the offered purchase price, but customs may vary from place to place. This money is a part of the down payment and shows the seller that you are serious about purchasing the home. The seller will accept, counter, or reject the offer. If the seller accepts, the house is taken off the market and the offer becomes a binding contract. When a seller counters, usually is with a higher purchase price, but they can also counter on the closing date, concessions, inclusions, and contingencies. Once your offer is accepted, you can arrange for the house inspection, which should be done by an independent, qualified professional, and either apply for a mortgage if you have not already done so, or let your lender know you found a home if you were pre-approved. The lender will start to prepare for closing. Avoid taking on any additional debt before closing. Your lender will probably check your credit report right before closing, and if they see any major changes, like the purchase of that new Lamborghini you've been looking at, they may decline your loan. However, if there are no problems, your loan will get final approval and the lender will be ready to pay out the mortgage funds. If you are purchasing the home with another person, you will have to decide how to hold the title to the home. There are several ways for multiple people to hold title. Tenancy by entirety is only available to married couples. In tenancy by entirety, both owners have a claim to the whole undivided title. Permission is needed from both the husband and wife to sell or refinance the property. With joint tenancy, the title is split in equal shares among the owners, and there is a right of survivorship, meaning if one of the owners passes away, his or her shares automatically goes to the surviving owners. With tenancy in common, Ownership of the house can be split by any percentage, but there is no right of survivorship. So if you pass away, your ownership shares goes to whomever you left in your will or trust. About a day or so before closing, it is a good idea to do a final walkthrough of the property to ensure that the seller did not take anything they were supposed to leave and the property is in the same condition it was in when you made the offer. Closing is the day the mortgage is finalized and the title of the house is transferred to you. In many states, the closing is handled by a title company. If not, it may be handled by a closing company or attorney. The closing disclosures, which list your actual closing costs, is provided 3 days prior to closing. If it varies from the loan estimate, ask your lender why. At closing, you will need a photo identification, proof of insurance on the home, and a cashier's check for the amount you are paying for closing costs and the down payment. After you sign all the documents, you will receive the keys to your new home and become a homeowner. Your mortgage payments will probably be higher than you're paying now for rent, but owning a home can provide a nice tax break. If you itemize your deductions, you can usually deduct some home-related costs, the most common ones being mortgage interest and property taxes, but please consult with a tax advisor for tax deduction eligibility. Now, what do you do next? Call your UCU loan officer at 800-UCU-4510 to begin the process, or visit ucu.org, borrow home loans, home buying services. You can also email real_estate@ucu.org. As a thank you for joining this workshop, UCU members can take advantage of a free and confidential credit report review counseling session. Once you've obtained a copy of your credit report, please feel free to reach out to Franklin or Michelle at the listed numbers on the screen. Thank you for attending our Becoming a Homeowner's workshop, and please feel free to reach out to me if you have any questions. My email and phone number are listed on the screen. Have a great day or evening.